Good morning. This is Lieutenant Dr. M. Vijay Kumar, Assistant Professor, Commerce, Head Department of Commerce, MVS Government Arts and Science College, Autonomous, Mahbub Nagar. Now, we are going to discuss the basic fundamental aspects about financial management. First, we will discuss the meaning of the financial management. According to J.F. Bradley, he defines financial management as the area of the business management devoted to a judicious use of capital and a careful selection of sources of capital in order to enable a spending unit to move in the direction of reaching its goals. Financial management, which deals all the financial aspects of a business concern related to the management. Another aspect, importance of financial management. Finance is lifeblood of nerve center of a business. How a human being survive with the blood circulation, similarly, the finance also lifeblood for the business organization. Just as circulation of blood is essential in the human body for maintaining the life, finance is very essential to smooth running of the business. The importance of financial management is the advent of corporate enterprise has resulted into the income in size and influence of the business enterprises. Wide distribution of corporate ownership and duration of ownership and management. The scope of financial management. The main objective of financial management is to arrange sufficient finances for meeting the short-term and long-term needs. The scope, it has a wider concept. Financial management for estimating the financial requirements of the business concern. It is to select a pattern of investment to be done and selecting a source of finance and proper cash management, implementing financial controls, proper use of surpluses. These all areas will be covered by the financial manager as his scope. First one, estimating the financial requirements, selecting a pattern of investment, selecting a source of finance, proper cash management, implementing the financial controls, proper usage of surplus. The objectives of financial management. Financial management is concerned with procurement and use of funds. Its main aim is to use business funds in such a way the firm's value or earnings are maximized. That is nothing but maximization of value of the business, net worth of the business. There are various alternatives available using business funds. By following the various methods of fund usage, the final objective of the financial management can be in two ways. One is profit maximization and another is wealth maximization. If we move the functional areas of financial management, one is determining the financial needs of the business concern. A finance manager is supposed to meet the financial needs of the enterprise. Selecting the source of funds. From where? From which source? We have to raise the funds. That is another functional area. And third one is financial analysis and interpretation. Whatever the funds raised and used for the enterprise purpose, and we have to make an analysis how the funds are flowing, and we have to interpret about the analysis. Then another functional area of financial management is cost volume profit analysis. It is also known as CVP analysis. Capital budgeting, long term investment process, that is the decision related to the long term investments, comes under the capital budgeting. Another one, working capital management, the short term investment sources, the management of short term funds in the enterprise, known as working capital management. Profit planning and control, and finally the dividend policy. These are the functional areas of financial management. Then we will move to the functions of a manager. The manager, finance manager particularly, he will look on various aspects. The most important functions of financial manager are financial forecasting and planning, estimating the future required finance, and planning for usage and planning for raising. Then second one, acquisition of funds. That is nothing but mobilizing the funds through various sources. Mobilization of the funds from different sources. That is acquisition of funds. The third one, investment of funds. Whatever the funds acquired by the enterprise, those must be invested in a proper manner, where the firm can raise more returns. Then fourth function is maintain proper liquidity. Liquidity is essential for every business. Liquidity which will give the working capabilities of the enterprise, smoothness of the enterprise, smooth functioning of enterprise in the short run depends on the liquidity. Then fifth function is helping in valuating decisions. Helping in valuating decisions to decide the values of the assets and liabilities. The finance manager has to do this function also. Management of cash, receivables and inventory. When operating cycle depends on the receivables and inventory, it is very essential to every manager to manage cash receivables which are due to the business concern, and inventory maintenance also. Proper inventory management leads to the profits to the business, and disposal of surplus. Due to the efforts of the manager or the collective efforts of all the personnel in an enterprise, the result whatever acquired, gained by the enterprise, that must be disposed in a proper way. That should reflect on the net value of the business concern, net worth of the business concern. And another function is performance evaluation and financial control. Financial manager regularly he has to evaluate the performance and making the control of the financial resources. Then we will move to the profit maximization. There are two objectives for the financial management. One is profit maximization, another is wealth maximization. Profit maximization. How? What implies the profit maximization? All the transactions, activities, functions of the financial manager, according to the traditional approach, is to maximize the profit of the business concern. How to measure? How to maximize the profits of the business concern? By increasing its revenues through improvement in the sales. Another method, by controlling the cost, by not reducing the cost, by controlling the cost of the business, we can get profit maximization. The third one is minimizing the risk. When the risk is minimized, there will be a chance of getting the profits. Then we will move to the decisions. Financial decisions refers to decisions concerning financial matters of a business firm. We can classify these decisions into three major groups. The entire financial management is based on these three decisions. One is investment decision, another is financing decision, the third one is dividend decision. These three decisions are also treated under scope of the financial management. We will move to the first decision, that is investment decision. The investment decision can be under two broad groups: investing for long term, investing for short term. The decision related to long term investment, the decision related to short term investments. The decision related to the long term investment is known as capital budgeting. The decision related to the short term investment is known as working capital management. If you move to the financing decisions, as a glance, once the firm has taken the investment decision and committed itself to new investment, it must decide the best means of financial commitments. From where we have to procure the finance, that is also very, very essential. Another one, dividend decision. The third decision on financial management is dividend decision. The third major financial decision relates to the disbursement of profits back to the investors who supplied capital to the firm. The best dividend decision, which will influence the net value of the market share or net worth of the business concern. Then we will move to the organization of finance function. The finance function is very vital for every type of business enterprise. The organization of finance function be diagrammatically shown below. The organization of finance diagram can be categorized in different ways. In the peak of the diagram, board of directors will be involved, and the board of director under the board of directors, a managing director, he will manage all the activities in association supported by the finance committee. And the managing director, vice president of production, vice president of finance, vice president of marketing / sales. And these three members will control the financial controller and treasurer. All together, there will be different branches in the finance. One is planning and control, another one annual reports, budgeting, profit analysis, accounting and payroll, additional funds, cash management, audit, protect funds and securities, relation with banks and financial institutions. This is the diagram by which we can understand the organization of finance in an enterprise or a firm. This is about the glance of financial management with basic meaning and objectives. Thank you.